It seems that we're all on the same page now regarding a slowing business cycle both domestically and abroad. So really the main question now is whether or not economies in Europe and in the US will only experience a slowdown or a more serious recession. Our main concern regarding the Federal Reserve here in the US is that it will be in the same position as the European Central Bank, which is increasing interest rates into an economic recession. So although the Fed needs to increase interest rates in order to be able to use monetary policy when economic growth slows down too much, we believe that the pace in which it does that is extremely important in order to avoid causing a mere slowdown, turning into a more serious recession. The battlefield between the bulls and the bears remains at the 2600 to 2750 level in the S&P 500. We spoke about this back in January. Some of the macro moves that occurred last week include volatility. It still remains at that 15 to 16 support level. For perspective, if you'll remember in 2017, the volatility index never went above that level, 15 to 16. So it's still pretty high. We'll need that to break down from those 15 to 16 levels for a sustainable market rally. Secondly, volume has been dropping on up days and increasing on down days, and we'd like to see just the opposite, again, for a sustainable rally. Thirdly, the 200-day simple moving average, which is a very well-known indicator, has proven to be a pretty difficult resistance level for the S&P 500 and the NASDAQ composite. Only the defensive sectors have moved above it and are holding, and that's really not the leadership that we'd like to see in a bull market rally. And lastly, Treasury yields, U.S. Treasury yields specifically, and the S&P 500, they've been pointing at a lower growth economic environment, while the S&P 500 has refused to move lower. So really something has got to give. The 10-year Treasury yield and the S&P share a very strong positive correlation. And lastly, our proprietary process is really not giving us the green light to take on risk at this time. Let's remember that this process has allowed us to avoid any significant bear market and pullback ever since the internet bubble. So for now, and this could change at any time, it's still indicating that we should stay long treasury bonds, bond proxies, aka real estate, and cash. So that's last week in financial markets in a nutshell. Thanks for watching.